Yes, we've got breaking news, the latest data on manufacturing, construction, and housing, all breaking right now. Economics editor Mike McKee is right with me here. Mike, some disappointment already on ISM.
Yeah, bad news on all the numbers, basically, but the ISM is one everybody's been watching. We've been driven by the engine of manufacturing for these many months, and now we have a big drop to 56.2 from 59.7. We were only expecting a move to 59. This isn't going to make anybody happy. The new orders index drops to 58.5 from 65.7 in May. The concern has been, can we keep up this manufacturing growth? And at this point, doesn't look like the numbers are going to be quite as good in the months going forward.
Factories at the forefront of what recovery we have experienced, and even overnight, we started being concerned about what was happening in China with their manufacturing activity there. This extending the concern. We have also said construction spending has also crossed. Walk me through some of these other figures that are breaking.
Well, construction spending is down 0.2%. That's a little bit better than expected. Residential construction down 0.4%, but non-residential down 0.1%. We were just talking in Betty's show about the possibility that some of the stimulus money would be coming through, and we see non-residential public spending up on the month by 0.4. So that may be a little bit of a boost to growth going forward. But
pending home sales certainly aren't there. Look at that, month over month down 30%.
Yeah, nobody should be surprised by that. We saw such a big drop off in existing home sales. People just, when that tax credit went away, they went away. Buyers just walked out. It's going to be a while till they come back in the existing home sales market, which is what pending home sales represent.
And this slew of economic data this week, and once again this morning, making so many equity investors in particular reconsider some of their positions, not just on the health of the market, but Mike, really on the question of whether or not this recovery is significantly slowing down at this point.
The problem we're going to have, Margaret, is that it can be a self-fulfilling prophecy. If markets react to these numbers and Americans see stock markets falling, they may pull in their horns and stop spending. You have to take a step back and say, okay, this is a surprising ISM number, worse than expected, but all the components are still reasonably high, and it does still signal growth. New orders 58.5, that's a very strong number, just not as strong as it was last month. Same with production. It's still in the 60s range. The employment number at 57.8 is still very good. And we saw a drop in export orders, but we're still in the mid-50s there. So the portents for manufacturing are still good. It may not just be as strong as it was, and that's what worries people because we haven't had much else driving the economy.
And that fear begetting fear, also bringing us back to the question in the equity markets about corporate profits. We're looking at, perhaps some headwinds out of Europe and the slowdown, stepping on what growth we may
Corporate profits have been very strong. In the first quarter, they were up 8%. Their companies are sitting on piles of cash.
Through to hiring, right?
That's the question: is when do companies have enough confidence to start adding workers? One of the interesting things to look at in tomorrow's payrolls report will be the number of temporary workers that are hired and the amount of hours that we work, because the trend has been keep your existing workers, work them harder, bring in some temps to meet the needs of the moment, but don't add to payrolls. If that continues, we're going to be talking about more than just a jobless recovery. We're going to be talking about whether spending can be maintained.